6 reasons why you should not do infinite banking. My name is Kyle Knott, and I'm not your average finance guy. And I talk a lot about the infinite banking concept, but it is not for everybody. And we are going to talk about a couple of those reasons today. I just did a video. This is a real life example over here of first year. He put in $20,000, and then he put in a lump sum of $10,000, and then throughout the months he put in $833 per month for a grand total of $10,000 more. So the first year he put in $20,000. He did $10,000 every year after that. After doing that for up until he was 70 years old, he would have put in $430,000 and had a grand total. Started taking money out. He would have, at the end of it all, 98 years old, would have taken out $1.5 million. Still had access to another $1.5 million by putting away $430,000. Go check that video out if you want to look in more into this example. But today we're going to talk about why you should not get into the infinite banking. And this is not for everybody. I'm not your average finance guy, and this is not for everybody. Some people just want to put their money into whatever Wall Street says and play the roller coaster, and it's kind of just disappears, and they don't really know what's happening, and hopefully there's money there at the end. And the bad thing is too many people look at their statement and think that's how much they have left to retire. But if you're in a traditional 401k or IRA, you still have to pay taxes to take that out. So yeah, your statement might say $1 million, but every time you take income while you're in retirement, that is now your income. And the more you take, the more you get taxed. So just keep that in mind. This is all, infinite banking is completely tax-free. If you do it right, it's all tax-free. So, or it should be tax-free if done right. All right, why you shouldn't do it. This is a long-term commitment. Okay, number one, this is long-term. This scenario that we ran is paying $10,000 a year for 40 years. So that is a long-term outlook to do something like this. And if you're just ready, if you got $20,000 to start and that's all you got, and you know you're not going to be able to make your payments next year, don't do this. This is a terrible idea. Okay. But if you know that you are going to have some sufficient income, your income hopefully will go up throughout the years, and you can afford to do something. And this is just one example. I know people that are doing $250,000 every year. Okay. And the numbers they just get wild. So it's wherever you're at, this can work. So, but it is a long-term commitment. Okay. Early years, if you take a loan out, you must repay that loan. So, say you're doing this, you're putting away 10 grand a year, and year 10, you want to buy a house. You have access, you have cash value of $128,000. You could take this $128,000 and plunk it down on, say you take $100,000 and you're buying a $500,000 house, and there's $100,000 and there's your down payment. You get a mortgage for the other $4,000, and there you go. Well, if you're only 10 years into this, and you took out a $100,000 loan that you don't intend, you don't have to repay it. But if you don't intend to repay it, this will not work. You will not. Yes, your cash value in the end will still be this, because you're never taking that money out. So your cash value will theoretically be $1.5 million. But since you took a $100,000 loan only 10 years into this, now your loan you still have to pay interest on your loan. Right now, the interest is 5.68, I think. So it's a lot better than most banks, but you have to pay that, or that just keeps compounding, and none of this. By the time you get down here, yes, your cash value would be 1.5 million, but your loan balance might be 1.3 million. So there's really nothing left to do there. So if you don't intend to repay, then don't do this. Okay. It takes about 4 to 6 years on average to break even. So in this example, this took it up to, it was year 6 before it actually broke even. So at year 6, we've put $70,000 into the policy, and we've got $70,137. Each year before that, you can see first year we put 20 in, you've only got 16. So when this number is less than that number, you haven't quite broken even yet. We're still pushing that snowball up the little bit of a hill. It's still pretty flat. Here it's completely flat, and it starts going down, and from here on off, you can see what we've actually put into it. We, like in year 40, we've put in this just example, we put 410 into it, and we've got 1.35 million of cash value. So that's when it really starts to take off and continuously compound. Okay, you must qualify medically. If you've had cancer, if you've had medical issues yourself, you probably won't be able to do this. This is a life insurance product, and they do look at your health. You can insure it if you have an insurable interest. If you've had health problems, look at your kids. Your kids probably, if they haven't had any health, you can insure them. Now, probably can't get to these kind of numbers, but if you have somewhat decent health, you should be able to do that. But you can always look. You can do a spouse, husband, a wife, a child, maybe even a parent in certain situations. But if you have an insurable interest, then you may be able to do this. It only averages about a 4 to 7% return. And I say only because I know the stock market sometimes can get a lot higher. It's all on how they push those, but there is basically zero risk. This is your floor. You will never make less than 4%, and you will probably never make more than 7. You might make a little bit more than 7, but average, you're probably on the high side. 7% is going to be your cap. Okay. Excuse me. If you want more risk than that, but look, this is a long-term, very low risk investment vehicle. And if you want to do more than that, and what I do too is I've got my policy, and I throw some money at the Wall Street game. I've got some stocks that I'm taking some chances with, and you can do both. But just saying that this is generally 4 to 7% return is maybe not the greatest. People that are selling 401ks and all these other instruments, look at their numbers, and a lot of times they're not what they seem. But this is a guaranteed 4 to 7. It's not the highest. I understand that, but you have a lot of options to borrow against this and then put it into an investment that cash flows, and then you pay this back, and now you've got this and the investment. So you can literally double dip when you do something like this. All right. It does take some education. You have to know what you're doing. I try to make a bunch of videos. If you've got any questions, please leave a comment. Look me up. You can text Kyle to 855-529-1388. If you ever got any questions, shoot them at me. Free of charge. I'm not charging anybody for this. Okay. And number 6, I just threw this in. If you want to remain poor for the rest of your life, I know there's probably a glare there, for the rest of your kids' lives and their kids' lives. If you don't want to set them up with a death benefit, like for instance, this illustration, this guy is 98 years old. He's 98 years old, put $430,000 into the policy, took $1.5 million out of the policy, still has access to another $1.5 million. And if he dies right here, his death benefit will be $1.78 million that he will leave to his children. And if they have the education to do this as well, they can use that money to set up another policy on them, on their kids. So you can literally just use this money you can get your kids' policies, you can get their grandkids' policies, and you can set your family lineage up literally for the rest of time if they know how to do this. And you put them into a trust and make sure that they know what they're doing before they get into this. So, all right, I hope this helps. Again, shoot me a text if you've got any questions. Leave comments in the video. I love it when you leave comments. I'll make another video on the comment, all these good questions that I'm getting. So I appreciate it, and good luck, everybody.